Let's get right into it. We're going to do this for an hour. We're going to ask for questions along the way. You can put them into the chat box if I find them relevant at the moment. I will ask Andrew. If not, we may wait till the end, but please feel free to put them in there. Let's go to the next slide. And Andrew, your favorite slide, everyone's favorite slide, the legal
Everybody's
disclaimer. Can you do this in 5 seconds or less?
definitely not five, but I can make it as fast as I can. So, legal disclaimer is this presentation is for information purposes only. Its content's not legal advice. We're going to be speaking in very broad generalities when we're talking about how to pitch investors. Every capital raise is different. There may be guidance here that applies to you. There may be guidance here that doesn't. So if you have specific questions about your concept, feel free to reach out to us separately, and we can give you some tailored guidance. This is really just a broad, high level conversation about some of the averages in the industry.
Well done. It's 10 seconds. Okay, let's go on to the first slide. And everyone, again, you can feel free to write questions to us in the chat box. Feel free to consider this a podcast and not look at us at all, whatever floats your boat. Andrew,
Yes,
how do
sir.
we know? The first question everyone says is, I'm opening up a restaurant, and how much money do I need to raise? How do we figure that out?
Anytime you're raising money from investors, it sounds obvious to say, but it's sometimes not. The best place to start is with a budget and a business plan. You want to figure out, how much your concept is going to cost to build out, and then all the metrics kind of follow from there, right? The valuation, the percentage you're selling, everything stems from that central question: how much money do I need? We always advise clients build in a buffer for professional fees, initial staff, working capital, the unforeseeable. This is a particularly relevant question today. The economic climate is a little uncertain. Projecting build out development costs with these kind of looming on again, off again tariffs is difficult, to say the least. So, our suggestion is always raise a little bit more money than you think you'll need. Come up with a budget, add a little bit of a buffer. Worst case scenario, you'll come in under budget and you'll look like a hero to your investors, and you have some working capital and a little extra working capital. You can make a distribution. What you don't want to do is come up with an aspirational budget and run out of money halfway through. Because then one of your first conversations with the investors that you just pitched is, hey, I need more money. And that's either going to be debt that, is senior to their investment, or it's going to be a dilution conversation that no one really wants to have. Um, so,
Andrew, I recently asked 5 of our clients who have opened up a total of about 30 restaurants.
mhm.
Tell me, after their budget is done, what percentage to tack on as a buffer. And the numbers I got ranged from 20 to 50%. Nobody was less than 20. And I asked why. And they said, well, because it's New York City, dummy. And these things happen. Someone's knocking on your door, DOB's giving you a hard time. Maybe, I don't know, your architect is going to raise his price halfway through. Maybe your GC is going to open up a wall and find something that they don't like. And, you start in with change orders, and all of a sudden you are just in the shit, as we say. So you got to be careful. If you can raise 500,000, you can raise 600,000, and you might as well.
Yeah. Another thing to remember is when you're raising money, a lot of times there are initial costs that you as the founder, the owner, have to put up front, right? You have to front certain costs like legal fees, accounting fees, architects, any business plan costs that you result in. Um, Remember to document those, because the way we like to structure capital raises is that any upfront costs ideally will be reimbursed once you start collecting checks from investors, because it's all part of that initial development cost, right? So don't think of how much do I need to raise as how much do I need to spend once I secure an investor. Think about that question as how much do I need to spend starting right now, right from the idea phase, the ideation of the concept through to opening. Because I think when people are adding buffers, that's part of what they're including, right? Is the fees that they're kind of shelling out here and there. It might be $500 here, $1,000 there, $5,000 there. It really does add up. So make sure you're documenting it even before you open your LLC. Just make sure you're keeping a record of it, because that's all part of what should be the total cost that you're in a perfect world passing on to investors. And what David and I like to do is structure offering documents to disclaim that some of this money will go to reimburse costs that have already been paid.
A lot of our clients come in and say, how do I value a company? It seems so weird to be valuing a company when I haven't opened my doors yet, or I have never opened up a restaurant before. And we oftentimes tell them to take it easy with the valuation. It's not that important. What is advice do you give to people when they ask you about valuations?
What I typically tell them is, again, start with how much do you need to raise? Start there, and then figure out what percentage do you think it's fair to sell. Usually, hospitality ventures, particularly first-time hospitality ventures, are selling between 20 and 50% of their business. The percentage you sell is impacted by that valuation, right? You want to have a business plan, you want to have projections, and you want to make sure that the percentage you're selling is in some way tied to that valuation. But something to remember too is a lot of that comes down to your leverage as an owner as well. The percentage that you sell to investors, which ultimately, determines kind of your overall valuation of the business, is almost as much dependent on their confidence in you as an operator. A Michelin chef who's opening their ninth concept and eight of them are extremely successful is going to sell a lower percentage and have a higher valuation than a first time operator, even if it's for the same space, same menu, same concept, control for every other variable. That difference alone is going to impact the valuation.
And
Yeah.
isn't it important to know when you're pitching? Because this is about pitching investors, and we're talking about valuation. Investors will say, how can your restaurant be worth X number of dollars? And what you always want to say is, well, don't worry about that so much. Look at my projections, and I'm showing based on a conservative forecast that I can pay you back within how long do you think?
Usually 3 to 4 years is what you want to see on projections. In reality, it's usually closer to 3 to 5 or 3 to 6. But yeah, I mean, we're jumping ahead a little bit here. I want to get into preferred returns later on, but you're basically telling investors we're selling you a certain percentage of the company, but we're giving you generally what we say is you're giving you the majority, if not all, of the profits up front to accelerate the point at which they get their money back, right? So then once they get their money back, their percentage of profit usually corrects and aligns with their percentage of equity. And everything they get from that point on is gravy, right?
Right.
Because what they want to know is how long will it take me to recover my capital? That question has nothing to do, to David's point, with evaluation and everything to do with the percentage of profit that you're pledging to them initially.
Mhm. Okay, let's move on.
Sure. So something we want to touch on very briefly, right? This presentation is going to be talking primarily about um, equity investments. And when I say equity investments, we're talking about selling a percentage of your business for money, right? You're taking on an investor. The other alternative is debt financing, which is basically, getting off the ground through a loan. Um, the if you're borrowing money and guaranteeing payback, that's debt financing. And we're going to talk very briefly about debt financing and the pros and cons of debt financing, because that's going to help us understand the pros and cons of equity financing, but also help us understand some of the landscape here. We have a lot of clients asking us about, should we do debt? Should we do equity? Should we do a combination of these? So when we're talking about how to pitch investors, we felt it was important to kind of start high level, talk about what these concepts are and how to think about debt financing so we can better appreciate equity financing.
Mhm.
So yeah, very simply, debt financing is basically just taking on loans, right? You are borrowing money and guaranteeing payback with interest. Loans, lines of credit, these can come from human beings, these can come from banks, lots of different shapes and sizes for these loans. Um, a
Let's
word
talk
of
about loans for a second, Andrew.
Yeah.
What I've seen, and tell me if you've seen others, there's two kinds of loans. If you're a first timer, first of all, forget going to a bank. The SBA is not going to give you a loan, most likely. They will string you along for 3 or 4 months and ask you for all kinds of information. And then at the very end, they will say, well, sorry, unless you have a home or some other collateral, we are not going to give you a loan. I have seen people start with loans from family. And
Mhm,
sometimes family will give you a loan and be like, yeah, here's a loan, here's $100,000. If you can't pay it back, don't worry about it.
mhm.
They're nice, We like those. We'll take those loans every day. Sometimes people like to give loans and turn it into equity. What is that called?
Yeah, that would be called a convertible note. You see this more and more frequently in certain industries like tech, right, or pharma, where you can't really come up with a valuation yet because you're just an idea and you're pre-revenue. So what investors are told is, I'll give you a loan, and then once you're ready to really go and collect money and go after investors, that loan will convert into equity at a preferred rate. The reason we don't love that as much in hospitality is essentially you're selling equity at a discount. You're getting all the downsides of debt by taking on debt initially, and then it's converting into equity at a discount. You generally don't need to do that in hospitality because you're raising money at a finite valuation. You have a business plan that's concrete. You're not selling an abstract app that may or may not ever go anywhere, and you couldn't possibly put a valuation on it when you're coding in a basement.
Mhm.
With a restaurant and bar, it's a little different. See lots of variations on this. You might have heard of this term SAFE, which is a simple agreement for future equity. Similar concept. I'm giving you money, we're kicking the valuation can down the road, and it's going to convert into equity at a discount. What does that mean for you as the owner? You're going to get diluted more than you otherwise would. You're going to
Right.
end up owning a lower percentage of your business. So usually if you're taking on debt, at least for a bar or restaurant, you actually want to gravitate towards just a traditional loan in a lot of cases because you want to prevent that dilution. And as David said, you're ideally, and we'll talk about this, we're jumping ahead a little bit with some slides we're going over, but there are ways to soften the risks of a loan, of taking on a loan to kickstart the business. We generally don't advise debt financing, by the way. It's an option. There can be advantages to it, but we more often than not see kind of traditional equity investments and for a variety of reasons, but we'll go into the pros and cons of debt for now.
Yeah, let's get into that just a little bit. Go ahead.
Yeah. So the advantages of debt financing, you're not giving up permanent ownership of the company. You're not diluting your control. When someone loans you money, they're entitled to their money back. They're going to get some interest on that money back, but nothing more, right? They don't generally get a say in your business. It's an arm's length transaction. It's pay me back my money and go about your way. So that's an advantage, right? You're not creating a permanent relationship with somebody. It's for lack of a better term, very transactional. Once you pay back your loan, your relationship with them is over. You get closure. It also means that there's a ceiling on their return. You know what you're paying them back. They're not going to make 10x what they lent you. They're going to make their principal plus interest, and that's it. An investor, though, theoretically could continue to profit off of your business forever. There's no ceiling on it. There can be certain tax advantages to taking on debt. I'm not going to go too far into that. That's something we'd recommend talking with your accountant about, but just know that can be a reason, particularly why some of the larger and more leveraged companies take on debt, is there can be potential tax advantages to doing that. But again, usually first-time businesses want to stay away from it.
But the big disadvantage is that you have to sign a personal guarantee for just about any debt you take on. So not the same with equity. Equity, your business doesn't do well, you go out of business. Okay, see you later, close up shop. If you have a personal guarantee on a loan and you have to close your business, you're on the hook. So it's
Mhm.
very risky, isn't it?
It's definitely risky. As David was mentioning, with a lot of these small business loans, it's a bit of a misnomer. Companies that have the best chance securing, let's say, an SBA small business loan is actually a large company that's starting a small business and leveraging, the risk of the small business against their large business. If you're truly a first-time, entrepreneur and you don't have any assets to secure, you're not getting that loan. If you're going for, a third party who's loaning you money, they're probably going to want some kind of assurance, right? Some kind of guarantee. And a lot of times that comes in the form of a personal guarantee. The business fails, you're personally on the hook for that. That is not the case with an equity investment. You're generally not coming out of pocket in the event that you don't repay an equity investment. So there's a huge
Mhm.
degree of risk with debt, both for yourself personally and for the company. Hospitality is, as we all know here, is a tricky industry, particularly in the first few years after opening. It often takes a business a couple years to get off the ground, to find its footing, get operations in order, find the right combination of staff to, finalize the menu. The first couple years of a restaurant don't tend to be its most profitable, right? So if you sign a loan agreement that requires payments in that first or second year, and you're not off the ground yet, you're not profitable, and you can't make those payments, you could actually go out of business before you have time to really find your stride. So
Okay.
depending on
So,
what the repayment schedule is of those loans, I've seen many times clients go out of business prematurely because they're saying, look, we were just getting to the point of profitability, but we couldn't keep up with our loan. We couldn't keep up with the interest. We never got off the ground.
yeah.
Um, and we have a lot of people who took on loans who said, look, if I just took on equity investors, I could say, wait, 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 not this year. And, they swear up and down that we would have been a really successful and profitable venture. We just need a little bit of time, and we didn't have that breathing room with our loan agreement.
Careful, careful with the loans, people. Let's move on
Yeah.
to
Yeah, just some, if you are debt financing, like we said, negotiate that ramp up period. Try to make it so that, payments don't come immediately due, particularly in the hospitality industry. It's very important. Try to keep interest rates low and avoid personal guarantees and securing the loan if possible, but that's easier said than done.
yeah.
All right. Equity financing. This is going to be the focus of the next 45 minutes or so. Um, Basically, equity financing is a fancy term for selling equity in the company to an investor. This is how I'd say 90% of bars and restaurants end up capitalizing. And it's how most small businesses, frankly, end up capitalizing. The reason people gravitate towards this method is, again, it's the lowest risk for the founder. You're not making any guarantees. You're basically telling an investor, look, you get unlimited upside if this is successful, but if this is not successful, you're losing your money, and there's really nothing you or me can do about it. That's generally kind of the understood conversation when you're talking to investors. So you're asking investors to take a huge risk. They're going to want things in exchange for that risk. They're going to want some protections and assurances. This is why it's important when you're going to pitch investors to know what to give on and what not to give on. Because investors are looking, again, to offset that massive risk of potentially losing everything with no recourse with some rights, some benefits, some protections. So let's talk about, what those are and how to navigate those conversations with investors. We covered this kind of already with the advantages and disadvantages of equity financing. The biggest advantage is you can repay an equity investor flexibly. If you don't make profit in the first year, you don't have anything to distribute. Investors might ask questions, but they're not going to come after you. They're not going to sue you. They're not going to, make you close up shop prematurely. If
They
you're
may
doing
threaten to
everything
sue
in,
you. They may get angry at you. One way to deal with that, Andrew, because a lot of times our forecasts show that we are going to be profitable in year one, and we're not because, well, it's the restaurant business in New York City. So how do you keep investors at large? How do you keep them at bay? I mean, like, how do you keep them from threatening you for getting angry? What I have found, and maybe you found some other things, is by communicating really, really well and
yeah,
being an open book and sending them frequent, at least quarterly P&Ls proactively. Don't wait for them to ask you. The moment an investor asks you for a P&L or finances, you're in the hole because now they're just like, well, why do I have to ask? So you got to offer it up.
yeah. Yeah, I think transparency is key, right? And this slide kind of talks about some of the advantages and also disadvantages of an equity investor. Um, One of the disadvantages is you owe an ongoing, what's called fiduciary duty to these people. Fiduciary duty is basically a fancy way of saying you owe a duty of care and a duty of loyalty to them. You have to manage the business responsibly. You have to be accountable to them. You have to answer their questions. You have to show them the books and records. And this is an ongoing duty for the life of the business. You don't just owe this until they get their money back. They could have their money back. Maybe they have received 4x their investment. They're still asking questions. You still have a duty to them to answer and to keep them in the loop. So the best way to handle that relationship is to just get ahead of it, right? Have a quarterly meeting, maybe have a monthly update even with these investors. Keep them in the loop. Make sure you're beating them to the punch because, as David was saying, if they're asking you for P&Ls, that question is often laced with distrust to say, I haven't heard from you. I don't like the fact that I haven't heard from you. Maybe I haven't gotten the distributions that you were projecting. And now all of a sudden I'm distrustful that you're doing things the right way. It would be much better in that scenario to say, hey guys, we didn't have a great quarter. Here are the P&Ls. Here's what happened. Here's what we're planning to do. investors will always receive that so much better than just silence because you're letting their imaginations run wild in that
And
case.
it shows that you have your shit together. I mean, if
Right.
you are putting together regular P&Ls that are tight with an accountant, I, as an investor, am going to have way more confidence in you than had you not, because at least I know you're watching. You're watching your bottom line.
Right. Right. A big theme of this presentation is going to be pick your investors carefully for a variety of reasons, right? This can be an advantage or a disadvantage. This is one of those items that's on both sides of this chart here. An advantage to picking the right investor is you are potentially building a lifelong relationship with someone who's not just financing the venture you're thinking about now. You have a great relationship with them and you build their trust through, as David is saying, these communication strategies. This is someone who can potentially back you for every future concept you want to do. And some of the most successful bar and restaurant owners out there, and even hotel operators out there, have the same kind of pool of investors that have followed them for decades, right? And that's been decades of relationship, of history, of trust that's been built up to the point where a lot of these people don't worry about financing anymore because they're like, I have a person who's going to throw money at anything I do because I've proven to be able to operate successful ventures that are profitable and they believe in me. So there's huge potential to build a very helpful long-term relationship that will avoid needing to go back to square zero, right, or square one with a brand new investor and make the same pitch and the same arguments all over again.
It's
That's
very
sort of
stressful to raise money. It's very hard to raise money. The economic landscape changes. People come and go from your lives. But if you have a pool of investors and you can make money on number one, they're coming back for number two. It just makes life so much easier. What are some of the disadvantages? Why don't we like equity financing?
yeah, the biggest risk with an equity financing in my opinion is a bad relationship with an investor. An investor just becomes a huge pain. They're asking questions every day. They don't trust you. They're making accusations that are probably untrue. They're claiming we're not profitable because you're doing X, Y, and Z, and you should be doing A, B, and C, and I don't like you. We have a lot of the biggest headache with investors is that breakdown in trust. Now, you can sometimes offset that breakdown in trust by communicating, but there are some people out there that are just unpleasant people. And if you pick the wrong investor, it can really create a negative experience and make you wish, I've already paid this guy 3x what they invested. If I had just taken a loan, I'd be done with this person already. Right. So again, I think that the pros of an equity financing almost always outweigh the cons relative to a debt financing. But the times where we have clients, complain to us and say, I wish I never did it this way, almost always are situations where they have just a breakdown of a relationship with their investor and they're trying to get them out. They're trying to buy them out. The investor wants, unbelievable amounts of money to get out, and you're kind of stuck with that person. It's like a marriage. There are great marriages. There are terrible marriages. It's very expensive to unwind a marriage. So make sure you're picking the right partners who believe in you, who are going to be hands off, who understand you're the talent. You know better than they do. Um, and again, try to preserve that relationship by keeping them informed, keeping them up to date, and just being organized, keeping your books
That's
and records
that's
tidy
it.
so that, you know,
That's it.
yeah.
Share your P&Ls. Be proactive. Just if you take anything away from this webinar, that will save your butt so many times. Just
Mhm.
keep your P&Ls tight and share them with your investors. Let's move on.
That's it. Yeah, so in an equity financing, there's a bit of a timeline that we advise clients follow, and it's pretty standard. Obviously, every raise is a little different, depends on the securities exemption we're pursuing, but generally speaking, you want to create a term sheet first. This equity investment term sheet is going to be a few pages. I know some people in this call have already prepared one and know this process well, but for those who haven't done one yet, it's a 3 or 4 page snapshot of what the overarching partnership contract looks like. That partnership contract is going to talk about who owns what, who controls the business, how voting happens, how profits are distributed, who owns the brand, all the very important terms that get negotiated. We want to get ahead of them. We want to be able to put something in front of investors to say, hey, I want your high level comments because once we get this raise going, we're not going to be exchanging 40-page documents back and forth a million times. We want to make sure we can get this money quickly and that we want all the comments up front so that we can accelerate the process down the road. This term sheet is going to complement your business plan, your deck, anything else that you're putting together for investors, whether they're visuals, whether they're just a summary of who the team is. It's meant to kind of complement the suite of documents you're already offering. It's very important to start here. We often, I have a lot of clients who over the years have felt, I've done this before. I know the investors. I can skip this step, right? And everybody's on the same page. Let's just go to the long form. More often than not, they regret that because you only think about what you're thinking about, and you get to the 1 yard line, and all of a sudden the investors comes back and says, "Actually, I marked this agreement up. Here's my new operating agreement. Let's just sign this one," and it's a totally different deal. And they've retraded everything, and all the assumptions that you made along the way turns out weren't correct, or even maybe they were correct, and there were other things that you didn't think about. So it's definitely good to make sure everybody's on the same page with the term sheet before you get too far along in the process.
Yeah, so don't go out there like slinging terms around. We've had a million people come to us and say, well, I've raised a couple $100,000, and we say, oh yeah, how? Well, I made this deal with my uncle, and I made a different deal with my aunt, and the terms are different, and then they're in a heap of trouble.
Mhm.
So the equity investment term sheet's important, and remember that that comes after the business plan, because you're going to be doing the dog and pony show out there, trying to get people to invest in your company. They're going to want to see the business plan with the forecasts. And then if they're interested, they're going to ask for the term sheet. That's next. But you got to have them both, and you have to have it ready. So if somebody shows real interest, you can hit them right away with the term sheet and get them on the hook. So we can get them into the boat with the operating agreement.
Yeah, that's right. And the operating agreement naturally follows from that equity investment term sheet because, again, the goal of the term sheet is to kind of summarize the more important terms of the eventual operating agreement. When you see operating agreement, think partnership contract. This is the agreement that everyone who owns equity, regardless of whether you're a 90% owner or a 0.1% owner, everyone is going to kind of sign on to this operating agreement. It's your master partnership contract. The subscription agreement, think of that as your investment contract. That's the document that says, I, an investor, am investing $100,000 for 10%. And I agree that this is risky. I'm not going to sue you if I don't get my money back. I understand, X, Y, and Z. I'm acknowledging these risk factors. I understand that this is not a registered offering. All of these kind of legal disclaimers are included in that subscription agreement, and it acts like an insurance policy for your business. It also helps ensure that we are complying with securities laws. So it's very important that the subscription agreement is kind of well tailored, it's carefully written, and it includes all of those important caveats. It's of the three, it's definitely the most boilerplate, but it is quite arguably one of the most important. So it's an important item not to skip and to remember that we want every investor to sign one.
Great.
Yeah.
Let's move forward.
All right. Rules of the raise. So this this presentation assumes, right, that we are raising modest amounts of money from a somewhat limited pool of investors who can kind of fit within the so-called friends and family category of investors. Um, there are state and federal laws which very strictly govern how you can raise money from investors. A friends and family raise is very straightforward relative to some of the other options out there. I could give an entire presentation on those exemptions, on securities law in general, on how to navigate this. It would put everyone, including me, to sleep. So, for purposes of this kind of high level presentation, again, we're assuming we're going with a friends and family raise. That's how most bar and restaurant raises proceed. But there are important parameters that exist on this friends and family exemption. There are other exemptions out there. Just so you all know, they generally are more expensive, more involved. They require you to file forms with the SEC, with state regulators. They require you to pay fees. It's just much more involved, and it will multiply the cost of your legal bills and your capital raise by 3 or 4x. So that's why we generally try to steer clients towards this kind of friends and family category to keep things as simple as we can. In order to qualify for this so-called friends and family category, you want to keep your investor count low, and you want to be careful about how you solicit and interact with those
What
investors.
does low mean, Andrew? How many is low?
The lower the better, right? Remember that every one of these investors is going to be entitled to questions. You're going to have to receive a K1. If you have one very rich hands-off investor, that would be ideal. but you generally want to keep the investor count below 15 to 20. If you get higher than 15 to 20, we're in a little bit of a gray area and we probably want to pursue a different exemption. What that means is some additional hurdles that we'll have to clear. Very doable, but again, additional hurdles, additional disclosure and paperwork.
It also becomes a full-time job, just keeping the investors informed or keeping them off your back.
Right. As much as you try to, group them together and have investor calls and investor meetings with everybody at the same time, inevitably, if you have 50 investors, good luck scheduling a call that aligns with 50 schedules versus scheduling a call that aligns with 4 schedules. It's just a different animal. And invariably, the person who invests for, 0.5% is going to have 50 times the questions as the person who is your anchor investor who puts in 10 times the money. It's just you generally want to kind of limit who you involve, both for legal cost reasons, but also just for operational efficiency and ease. So you want to keep your investor count low. You want to limit the offering to high net worth individuals. No one should be mortgaging their house or selling off their 401k to invest in your business. You only want to be offering to people who can afford to withstand a complete loss of their investment. Um, Only communicate with your investors across private channels of communication. This is a big one, and it's one that it's easy to miss. Some people get really excited about the capital raise and put out something on Instagram to say, hey, if you're interested in investing, hit me up or DM me. That is a very innocent, innocuous, but problematic thing to do because now all of a sudden, from a legal perspective, now it's a public offering because you're soliciting investors publicly. And a public offering is much, much more complicated, much more expensive than a private one. So when you're talking to investors, make sure you're doing so privately. Try to have one-on-one conversations. Don't lump people together. Really invest the time that those conversations require and make sure they're, direct. Don't, have somebody else have the conversations for you. Try not to use brokers if you can get away with it. And, just try to keep the conversations tight and intimate. Again, I could go on all day about the various securities kind of regulations at play here, but we're trying to keep this high level. If you have questions about your raise and securities compliance, please reach out to us because every circumstance and every raise is a little different.
Excellent.
Yeah. All right. So this is probably the question we're asked most often. I'm certainly asked this question most often, David. I don't know about you, but it's one of the
Yeah,
most
number
important
one.
questions that can be asked. It's what percentage do I need to sell? Let's say I am a bar owner and I know I want to raise $1 million. What percentage do I need to sell to investors? I want to sell as little as I can get away with, but of course I can't sell 1% for $1 million because then my valuation would be insane. So what is a reasonable compromise on trying to maximize as much equity for myself as the founder while giving investors a fair shake here? And the answer generally is somewhere between 20 and 40% is the equity that you are selling. This can vary. We've seen 15%, I've seen 55%. It really depends on how much you're raising and how experienced you are as an operator, how much leverage you have as an operator. Your experience directly speaks to that leverage. If you are successful and you have 5 successful concepts, you're probably going to get away with selling closer to 20% for that concept than someone who's a first time operator. You're not going to have as much leverage to argue that your valuation should be higher. Um,
As you start to create a track record, and as you can show investors that you are someone who knows how to make money and return investment, your leverage will skyrocket.
mhm.
So on your first restaurant, you may have to give up 40 to 45%, let's call it 40. But on your third one, after you've showed investors that you've paid everyone back within 3 years of your first 2 restaurant, same exact concept, you may only have to give up 20%.
Yeah, yeah. And it's an interesting conundrum because again, yes, as David's saying, your valuation is not irrelevant, right? You have to come up with projections and a business plan and come up with a valuation. But in reality, it more has to do with investor confidence in you and how quickly you can pay investors back and how confident investors are in your projections. If you've shown, hey, this is my 4th rodeo and I've been, it's been a home run for the first 3, they're going to take your projections at face value, more or less, relative to somebody who's never done this before and it's a riskier endeavor. So think about kind of your leverage and where you are kind of in your hospitality career and your portfolio when you think about these numbers because leverage definitely matters. Another thing that matters immensely is the scalability of your concept and the brand ownership. If you were telling investors this is going to be a quick serve and this is the first of three that I want to open this year, that's going to affect your valuation and help you justify selling a lower percent than if you're telling investors you're investing in this brick and mortar only. I own the brand. And if I open a second one, you're not coming with me, right? Because basically, from an investor standpoint, what they want to know is, am I getting in on the ground floor of something that can grow, or am I investing in a lease? It's very, very important. And that fact is, I won't say it influences the valuation more than anything else, but it influences the valuation as much as anything could. So we'll talk about this in a few slides, but knowing who owns the brand and making sure your messaging is clear to investors is very important. What I will say is now more than ever in the past couple of years, investors really care about this. The pandemic changed the investor conversation a little bit. People are more concerned with making sure you have kind of a diversified portfolio. They don't want to just invest in one concept. They want to invest in a group so that if one concept fails, the other, at least we have some other ones that are footing the bill and picking up the tab here. The pandemic changed the conversation a little bit. David, I don't know if you've experienced this, with the conversations you've had with clients as well, but I've certainly, since the pandemic, seen investors care more about this issue, and they'll specifically ask, who owns the intellectual property of this business?
Yeah, the IP becomes everything, and the industry has shifted from people opening one concept in one place to people considering hospitality groups and spin-offs and having portfolios that are full of different business ideas. You may have
Mhm.
a QSR spin-off of your brick and mortar. You may have a CPG spin-off. You may have some licensing and management deals coming through. So I think investors are getting savvy to this, and they're starting to look to the IP as the real value in the investment.
Mhm. That's right. So know that, while it's possible to go to investors and say, look, I personally, as the founder, me and my co-founder want to own the brand. If we open locations 2, 3, 4, and 5, you're not coming with us. You can do that if you get ahead of the conversation. You have to make that really clear in the documents you're offering them. But it's going to have extreme downward pressure on the valuation, and in some cases, just the terms that the investors are being offered. They're not going to be as excited about it. That's
Mhm.
okay. It's not going to defeat the possibility. We have plenty of deals go to market successfully where ownership of the brand is not shared. But it's a conversation that definitely affects this general and very simple question: what percentage of my business should I be selling?
Yeah.
I think we can go on to the next one. Another very important thing to know is when you are pitching investors, investors generally expect, at least in the hospitality industry, a preferred return on their investment. What that means is that the investor class or the investor group, let's say you're selling 30% of the business to the investor class. You're generally not going to give 30% of profits to the investors initially. You're generally going to pledge a much higher percentage of profits to the investors, usually somewhere between 80 and 100% of profits to the investors to accelerate their payback. And David alluded to this earlier, and it's absolutely right. When investors ask, what's the valuation? That's the wrong question, frankly, for investors in this industry. They really should be asking is, what's my return on investment going to be, and when is it going to happen? The
Because
preferred.
investors are afraid.
Mhm.
Investors are afraid. The longer their money sits out there, the more fearful they are that they're not going to get it back. So you have to allay their fears by letting them know that you're going to get it back faster. Not only are you going to get it back faster, but I'm not going to take my 80% that I'm due of profits until you get your money back. Boy, that goes a long way in making an investor feel confident.
It aligns interests, right? You don't get the lion's share of profits. In some cases, you don't get any profits, depending on how you structure it, until they get their money back. So it's making sure that founders are motivated right, to accelerate that payback as soon as possible because time is money, right? Investors want, they don't want to get paid back to 20 years from now. They could have just put it in the market and made that money by then. They want to get paid back quickly so they can start getting a return on their investment earlier. And again, that 3 to 4 years is generally what you want your projections to say. In reality, it's usually closer to 3 to 5, if not longer. Um, but this preferred return allows you to sell a lower percentage of the business than you would otherwise be forced to in order to hit those projections, right? You can get away with selling, let's say you're an experienced operator with a ton of leverage, you can get away with selling 25% of your business. If you gave 25% of profits to that group, you could never get away with that because the
Mhm.
investors would say, how long will it take? And it's like, well, at 25%, it's going to take 10 years. And they say, no, thank you. But if you're giving 80 to 100% of profits to that group initially, you're accelerating their payback and you're justifying selling investors a lower percentage so that you, as the founder, can get the lion's share in the long run. It's very fair, it balances risks, and it's so uniform that I could probably count on one hand the number of raises we've done last year that did not have a preferred return.
Okay,
Um, Another thing to think about is avoid S corporations at all costs if you are raising money. Um, S corporations, we see them frequently, especially if somebody's managed the business on their own. There can be certain tax advantages to paying yourself through an S corporation. The second you bring on a business partner or an investor, you want to do so generally through an LLC. The reason we don't like S corporations is you can only have one class of stock in an S corporation. What does that mean in practice? It means that you cannot offer preferred returns. You cannot treat your investors differently. You cannot do what we just described as best practice. People who raise money through S corporations therefore have to sell much higher percentages of the business
Mhm.
to get investors paid back within even remotely the same timeline. So if you're raising money, always, always, always do it through an LLC, occasionally through a C Corp, but we generally don't like C Corps. They're not tax advantageous. It's almost always LLCs that you want to form. Very, very important. The only thing that really frustrates our ability to run a capital raise in a way that benefits the founders is that S Corp election. So just be very careful before you elect an S Corp for any kind of operating company.
Great.
Management fees. We've been talking about the idea of pledging all of the profit to investors up front. Begs the question, how are you, as the founder, how are operators supposed to pay themselves in the meantime? The answer is management fees. Management fees are essentially salaries. They're just not called salaries from a tax standpoint. They're called guaranteed payments or management fees. This is basically the salary that you are taking. It is an expense. It is paid to you before profits are calculated and distributed. Um, it's very important to bake these into your term sheet and to the eventual operating agreement so that investors know that you are getting paid a salary, that you're not working for free. So that if there's, if they're looking at a P&L after year one and they were told by you you're getting 100% of the profits, they're not going to look at a line item and be like, wait a minute, David, I thought I was getting 100% of the profits. Why are you getting paid? You can say, well, one, I'm insulted by the question, but two, of course, I'm getting paid a salary. This is my full-time job. I have bills to pay. I'm a human being on planet Earth. I need to make money as well. It's very important to get ahead of that conversation and make the management fee disclaimer early so that you avoid that uncomfortable conversation with investors, particularly if you're break even. If you're break even and investors are not getting a distribution check, they're going to look at every line item there. And believe me, if you're making money and they're not, generally investors have questions about that. Get ahead of that conversation and you won't have any issues.
You put in the number $150,000 a year. Is that typical for a management fee as a floor?
It depends. Usually a management fee is going to be a percentage of gross revenue. We like to do the greater of a percentage of gross revenue or a guaranteed minimum so that way, COVID is a good example of why we like to do this. During COVID, you might have had to close, but that doesn't mean your work stops. So management fees that were expressed as a percentage of revenue were dangerous because now people couldn't pay their rent, right?
Mm.
If you were relying on a management fee to, pay your bills. It's not your fault it's closed. You have lots of things to do. Maybe, you're running delivery service or you're working with partners to try to pivot your concept. You're still working, you should get paid. So that's why we like to have a guaranteed floor there to accommodate unforeseeables.
Do you
um,
ever um do you ever put into agreements that number kind of increases as time goes on, or if the business is more successful?
Sometimes the nice thing about making it a percentage of revenue is, if it's the greater of those numbers, ideally the percentage is going to be the greater. So if you're doing well, you're going to be making more, right? Your
Mhm.
percentage scales automatically. You could talk about a bonus structure and say, oh, if we hit X number of dollars a year, I'll get Y as a bonus. But if you're also an owner and you're getting profits also on the back end, usually your profits kind of stand in for that because whether you call it a management fee or a profit share, you're kind of profiting either way from the upside, and generally that's enough. But again, it really depends. A managing member who spends 3 hours a week at a restaurant should not make the same management fee as someone who spends 80 hours a week at the restaurant. I always tell clients to think of management fees in relation to your overall labor cost, right? There are plenty of managing members out there that are very active. There are plenty of managing members out there that are very passive. The management fee should be part of your overall labor cost and make sure that your overall labor cost is acceptable. Um, so, if you're passive and you're relying on other people to do the day to day, your management fee is going to be a little lower than if you were active and you were, boots on the ground and your role was standing in for a full-time employee. So think about that when you're thinking about management fees. But 5% is customary for a management fee. But again, it assumes a level of kind of active involvement and engagement.
Yeah.
So there are higher and lower management fees out there that you'll see as well.
Okay.
Yeah. Intellectual property. We touched on this a little earlier. This intellectual property is basically your brand, right? It's your name, it's your logo, it's your trademark if you have one. It even is your proprietary recipes. It's the look and feel of your restaurant. It's your trade secrets. It's your customer and vendor list. It's everything that's unique to you that you wouldn't want to post on the internet for everybody to see. It's very, very, very important to remember that just because you're not applying for patents and you're not a tech company and you're not a scientific company or pharma company, IP still applies to your business, right? One of the biggest mistakes that I see in clients, particularly that use, like LegalZoom or a form they found online for their operating agreement, is very few of those forms talk about intellectual property ownership. And it's not an issue that will come up unless you're very successful. Let's say, you launch a diner with a group of investors and it's really, really successful and you want to launch a second one. The question becomes, okay, what does that look like? Who comes with me? Do I have to bring these investors with me or not?
So if you own the IP, Andrew's Diner
Hmm.
in Hudson, New York, and it takes off, and then you want to go across the river and open up Hudson Diner in Kingston, and your operating agreement says nothing about intellectual property and who owns it.
It's a very good argument could be made that the company owns that IP, especially if that's the first time the IP has ever been used. Right? And think about it. Imagine you're investing in this diner. You're investing in my diner. You're taking the biggest risk. I don't know whether this is successful. You don't know whether this is going to be successful. This diner would not exist without your money. I wouldn't have an opportunity for a second one without your money. It's reasonable that the investor should say, well, why are you profiting off the second location when I'm the reason you're in this position to begin with? It's a reasonable argument. We can offset it by setting expectations up front. But if you don't set those expectations up front and say, hey, investor, you don't own the brand. If I open a second one, I'm doing it without you. The assumption is going to be, I'm an investor. I have to be involved in some way. That
So
doesn't mean, yeah,
you're
go ahead.
really hamstrung.
Hmm.
If you're not laying this out in the beginning and you want to open up more Andrew's Diners, you have to go back to that initial investor pool and ask permission. And guess what they're going to do? They're going to say, sure, but we want to cut, or we
Hmm.
want to be included in it. Or if you open up another place, you have to pay a licensing fee back to us, all kinds of stuff. But no one's going to just say, oh, sure, no problem.
Yeah.
Enjoy. Good luck.
And they may want different things, and that makes it that much more complicated. I've I've had a number of clients, even in the past 12 months, experience exactly this. I'll tell you how it usually plays out. It delays expansion, and you either have to fold in the people you like into a parent company and do a whole expensive roll up to set up the infrastructure for growth, or you buy those investors out to basically clear the table, reshuffle the deck, and say it's just me now. I'm going to open the second one, but it could delay your expansion by years and years and years.
Mhm.
Um, So it's very important to get ahead of this.
So how do
That's
you
why
make
this.
that pitch? How do you make that pitch to an investor when you're opening up Andrew's Diner and you say, you know what, investor, I actually am going to own the IP here.
Mhm,
It's not going to be the company. And the investor says, what?
mhm.
How, why on earth would I agree to that? What's your response?
People who generally have the most success in making that argument are very experienced operators who, are in a better position. Not again, you can never make any guarantees, right? But to project a profit, right? If I'm a Michelin chef and I'm opening a new location, I'm like, I'm not sharing this, but it should be privilege enough that I am tapping you to participate in this venture. Sometimes that is enough, right? If you are excited enough about just that standalone concept and there's enough star power behind it, or there's enough history behind the group doing it, they say, look, I'm not looking at this as I'm not trying to be a part of an empire. I'm happy if I 2x my investment here, like they say I'm going to.
Is there something you can say to appease investors? For example, if you
Mhm.
say, look, I'm going to own the IP, but of course, if things go well, I'm going to look to my initial investor pool and see if I can bring them along. Does that do the
Yeah.
trick?
It generally does. So if you're telling investors they're not going to participate in brand ownership, which means they're not going to get automatic rights in future expansion, a very common compromise, and this is our third bullet in the slide, is to offer them a right of first offer to invest in future locations. So let's say Andrew's Diner is very successful. David, you're an investor in Andrew's Diner. I'm opening a second one. I'm going to go to David with an opportunity to invest before I go to anybody else. And I have to offer David the same terms I would offer anybody else. Let's say David says no and I change the deal. I can't go to another investor before I go back to David with that change deal because I have to give him first offer on whatever terms I go out and offer other
But
people.
if they say no,
Mhm,
then I open up my third. So they say no, they're out for number two, but number two is twice as good as number one.
mhm.
And then you're at number three. Usually, if they say no, they're out, right?
Depends on how it's structured. Usually, it's not one strike and you're out. Usually, it's a few. But yeah, we generally like to say, if you decline to invest in a certain number, generally you don't have that right anymore.
Okay.
Frankly, though, if you're really trying to build out a large hospitality concept and you're trying to build out a brand, chances are at some point you want to form a holding company and bring certain investors into that parent company anyway to just make it easier to finance future expansion. But that's a webinar for a different time.
What percentage of our clients who open up restaurants do you think get to own the IP outright?
A third,
A
maybe
third.
a third. Yeah.
So it's an uphill battle to ask for
It's
it.
definitely an uphill battle. And if you had asked me that question pre 2020, I would have said 50%.
Mhm.
I say right now, again, the hospitality climate right now is all about economies of scale. Investors are generally only biting at concepts that they feel can be replicated and can grow. They're
Mhm.
not generally excited about investing in a corner spot and letting it just proliferate as a single location. They want to invest in something scalable.
Mhm.
So the IP, conversation is at the forefront of any investor discussion because that dictates how you expand and how you grow. So, if you're trying to sell investors on the idea of scalability, it's almost impossible to do that without sharing IP ownership.
Gotcha.
Yeah.
Okay.
Voting rights. This is another question that comes up frequently. To be clear, when you are pitching investors, you want to make abundantly clear to them that the general rule is that if you have any partners, you and your partners are in control of day-to-day operations, and you are the creative minds behind the concept, right? Remember, you're asking investors to take a huge risk and to potentially withstand a complete loss of their investment. So, what a savvy investor is going to do is say, "We acknowledge you're in charge of the day to day. You know how to run a restaurant. We don't, but there's certain exceptions to that rule. If you want to undertake a certain major decision, we can list what those commonly are. You need consent from, let's say, a majority of the investor class in order to do that." And that's a common compromise that companies have to offer investors to help them feel like they're protected, help them feel like they have a seat at the table. I'd say 70% of the deals that we see offer voting rights to investors in some capacity. This is a topic that varies dramatically based on how much leverage you have and how experienced as an operator you are. If you're operating 9 restaurants super successfully and this is your 10th, your investors probably aren't going to be too concerned about approving things because you've earned their trust. If this is your first location and you have no operating history, you're going after a sophisticated investor. That investor is probably going to want you to go to them when you're at major crossroads. And you know what? You might want to because you don't have the experience, and maybe the investor is experienced and has some input and insight for you. So, voting rights are an interesting topic because they're not necessarily bad to offer certain voting rights to investors, but it's all a question of degree, and it's all a question of what kinds of things you're comfortable offering as a discussion point that investors can weigh in on.
So let me ask this question that's been asked by one of our viewers. How common is issuing non-voting class B shares to investors?
Um, it's probably uncommon, but it's not unheard of. It really depends on who your investors are, right? If your mom and dad are your sole investors, you're probably offering non-voting, shares because they're not going to say, "Oh, son, if you sell, you better have dad's approval, or it's not happening," right? But if you have a group of investors who aren't related by blood, and again, you're not an experienced operator, more often than not, they're going to want voting rights. I've seen first timers succeed in raising money without giving voting rights. I've
Mhm.
seen Michelin star chefs fail to raise the money they need without offering voting rights. So it's not a one size fits all here. It really depends. And again, voting rights aren't necessarily a bad thing. I've had a lot of deals that I've worked on this past year where very experienced operators are specifically targeting investors who are experienced because they want their input. So maybe it's not voting, maybe it's consulting rights that you're giving investors. And that's not only a benefit to them, it's a benefit to you to say, look, if I want to grow, if I want to expand, if I want to dilute, if I want to do something that's pretty nuclear in scope,
Mhm.
I do actually want the perspective of these people who have invested in hundreds of companies and who might be able to offer some insight. So
Let's talk
it's a
about how to
nuanced issue. Mhm.
let's talk about how to rid yourself of unwanted investors.
Mhm. There's no easy way to do it. It's the if you want to if you're not getting along with an investor, the simplest way to get rid of them is to buy them out. A question I get a lot is, well, can I just put a buyout clause? Can I give myself the right to buy an investor out at any point I want? The answer is yes, but good luck. Because remember, investors are taking a huge risk here by investing. They generally don't want a ceiling on their potential return, right? Especially in the bar and restaurant space. The failure rate of hospitality concepts is astronomically high. If you are getting somebody to take a 7-figure risk on you, they generally don't want to wake up one day and say, "Oh, I was bought out today. I guess I'm not 3xing my investment. I'm just getting X number of dollars. Okay, that's hunky dory. I'm fine. I don't care." Yeah, they're going to feel some kind of way about that. So it's not impossible to force a buyout, but it's very, very unusual, which means that in most cases with hospitality capital raises, if you're not getting along with an investor, you have to negotiate a buyout and you have to offer them a number that makes sense. They don't have to take it though, generally, right? And that's why it's very important to pick your investors very carefully. Um,
Let's talk about how to reward investors who are lovely people, who are helping your business, who are there for you when you need them.
mhm. Yeah, it's you generally want to bring investors in on the same terms, right? You don't want to give, even if someone's investing more money than someone else, you don't want to create different classes. That's going to complicate things. You don't want to, have the most complicated operating agreement in the world where different people get different things. You want to standardize it. If I invest more than a fellow investor, I have a larger chunk of the company. I get paid back at the same time, though, because everything's proportional. An easy way, though, to incentivize major investors is to give them perks not relative to the corporate governance of the company, meaning profits, voting, that kind of thing, but relative to the restaurant itself. Give them priority reservations, give them discounts, give them comps. Say you'll have, you know, X number of perks at the restaurant if you invest that this much, and make sure that every investor is offered the same thing. That's a very easy and common way to incentivize people, to invest. If they're between investing 75K and 100K, maybe say, look, if you invest 100K, you're going to get access to, this newsletter. We'll give you comps up to X. We'll guarantee certain reservations. We'll, discount private events by Y%. We've seen a lot of success there, and that can help not only keep your investor count low by keeping the average investment high, but it can incentivize people to open their purse a little bit wider and say, if I'm between 75 and 100 and I'm a billionaire and it's all the same to me, I might as well do 100 and get these perks.
Mhm. Nice.
Yeah,
All right. Well, wow, that brings us right to the top of the hour, Andrew. Well done.
thank you.
Now we're going to open the floor to anybody who is tuning in. You can ask any kind of questions, and we will answer them if we can. I like to give people a couple of minutes. We had a bunch of questions come in along the way. So please feel free to send us a question in the chat box and we will answer them. How's the investor landscape these days, Andrew? Are we seeing people raising money?
We are. And knock on wood, so far so good. I haven't really seen any slowdowns quite yet. I've seen some trepidation with new projects getting off the ground because again, coming up with budgets right now is difficult with the tariffs and the cost of labor and the cost of even something like lumber. Like nobody knows what that's going to cost. So there's a bit of a slowdown when it comes to creating budgets for new projects, but if a raise is already underway, anecdotally, knock on wood, I have not seen a slowdown quite yet. It seems like people are pretty optimistic for the industry, and particularly in spring, it's a perfect time to raise money because everybody's excited for spring and summer, and everybody wants to say, every investor out there wants to say, I'm a co-owner of this spot, and take their family, to the sidewalk cafe outside their favorite restaurant. Everybody wants to do that.
Here's a question for you. Do investors expect you to pay their income tax on their investment if they didn't get a distribution for that period?
That depends. Sometimes, yes. Tax distributions aren't something we offer by default, frankly, because we would want to talk to a company's accountant before offering that. Because what we essentially be doing if you're making tax distributions is promising investors that the accountant's going to do homework and work that we are not empowered to do. So sometimes investors will ask companies to make tax distributions to cover any tax burden. And it's not an unreasonable ask, and it's certainly not uncommon, but it is something you want to make sure your accountant's on board with, and you want to know what the cost of that is from your accountant before you commit.
Here's another question. Does all of this information apply to event spaces and hotels?
That's a good question. Hotels, a little bit different. It really depends on if you're raising money for a restaurant within a hotel, then yes, I would say yes. If you're raising money for the hotel itself, it's a little different. I don't know how comparable this is. Um, Event spaces depends on what the event space is. Is it an event space in a restaurant? Is it an event space in a retail space? Then generally, yes, these kinds of rules will apply. But again, every raise is a little different. The larger the financing, the more likely we're getting venture capital involved, and we might have some different considerations and figures here.
Here's a question about additional fundraising during a raise. If we need to add more capital because of any number of issues, tariffs, additional build-out expenses, going for liquor license, etc., is there a better or worse time during the raise to let current investors know that we need more money?
It's a really interesting one. Generally, so I will say this, generally the earlier the better. However, you don't want to rush it because you want to make sure you know what the revised budget is. You don't want to be in a situation where you change the budget 1 week, then you change it again 2 weeks later, you change it again 3 weeks later, you change it again 4 weeks later. As much as you want to, be very transparent and open with your investors, what I would say if you're unsure of the budget is don't take any new investment until you have the new budget, right? And then figure out what that new budget is. You want to make sure generally your investors get the benefit of the new budget, of the new raise. They have the opportunity to buy in at the new valuation. In most cases, if you're raising more money mid-round, sometimes the manager class or the founder class takes the dilution hit so that the investors don't have to, because you don't want the investors to feel like they were bait and switched. A lot of different ways to kind of structure that, but you don't, that's one of the few areas where you don't want to actually be too hasty. As much as you want to be upfront with investors, you want to take a breath, slow down, and make sure you get your bearings before adjusting terms. Just don't be in a situation where you accept money from an investor today and you change the metrics tomorrow.
Here's a question from a broker consultant, basic question. How do I find investors for my clients?
It's a good question, and it's a tricky one to answer because there are very strict rules on kind of broker dealer how you can basically be a broker of securities. You can't get paid in exchange for making those introductions or securing investments unless you're a registered broker dealer under FINRA. It's a rule that's kind of weird and very often forgotten about and neglected. But just keep that in mind if you're trying to make connections between people. That's totally fine, and you can do that. Just make sure that the principals of the business are in direct contact with the investors and that those conversations are happening directly between the owners and the investors. Don't be the intermediary and don't, monopolize the conversation. And you can't get paid in direct exchange for that, making that introduction or securing that investment for someone else unless you're a registered broker dealer.
But finding the investors, I mean, there's no way to find investors. You have to go through people who you know, people who have eaten at your clients' restaurants, friends, family. Unfortunately, there's no real network of
Yeah.
investors out there that I know of.
No, there's really not. Regulars are usually a big source of, or at least the starting point, right? Friends and family are obviously first, but regulars often help fill in the blanks. And regulars can say, look, I brought my friends to this place. And, if someone's very wealthy, they tend to run in wealthy circles. And, talking to regulars is an art. It's tough. You don't want to, poison a relationship by saying, "Hey, want to invest in me?" They might be offended. Who knows? But generally, if you have a good relationship with your regulars, it's a good source of potential funds as well.
Okay, well, thank you, Andrew. That was fantastic as always. And thank you, Alex, on the ones and twos. Alex, when is our next webinar and what is it?
We will be back 2 weeks from today on April 28th with Tipu Riaz digging into consumer packaged goods.
And what's the one after that?
After that, we've actually got Andrew back with Hamatal Lieberman on May 5th for building and protecting your brand.
That's going to be a great one. Okay, well, thank you, and thank everybody for tuning in, and we'll see you soon.
Thanks, everyone.